Hello, everyone. My name is Michael Ayachi. I'm a partner at KPMG in Luxembourg, head of the Luxembourg Tax Center, here currently based in the US.
Hi everyone, my name is Kees van Meel. I am in the Netherlands Tax Center of KPMG in New York. And in the coming 20 minutes, Michael and I will take you through the ATAD3 rules as proposed by the European Commission and their impact specifically on holding company structures. So the next slide, the nutshell. The draft Anti-Tax Avoidance Directive, number 3, is aimed at preventing the abusive use of shell companies. And shell companies in this context are typically companies that generate cross-border income with a portfolio character. And you can think of rents, royalties, interest, and dividends. Some carve-outs and exemptions apply, but in the scope of this presentation, we will not go into too much detail because it takes too much time. And like I mentioned, the rules are laid down in the draft directive of the European Commission, and the proposed entry into force is January 1st, 2024. Now, the directive aims to prevent the abusive use of shell companies by introducing minimum substance requirements. The directive first provides a number of so-called gateway tests in order to determine whether a company as such qualifies as a shell company. And if that's the case, it has to report on its economic substance. And if the economic substance is insufficient, this may result in denial of treaty benefits or denial of a certificate of residence and in exchange of information. Now, once the directive is adopted, the 27 EU countries need to implement the rules in their domestic legislation. The wording of the directive will then typically share as a minimum rule, and it implies that individual EU countries cannot be more lenient in the transposition of the directive rules in the domestic law, but they can be more strict. Now, why do we focus on holding companies? Well, in practice, what we've seen over the last years is a large reduction in the number of back-to-back licensing and financing companies that typically are also shell companies that have no or limited substance. And the use of holding companies has more or less remained rather widespread. Now, it's very important to realize that the proposed ATAD3 rules as such do not have any impact on the question whether a company is entitled to treaty benefits. The answer to that question depends on whether one of the many anti-abuse provisions apply that over the last years been introduced, both in international context as well as in domestic legislation. And you can think of the GAR, the General Anti-Abuse Rule, the Principal Purpose Test, or the PPT, that was included in the multilateral treaty. And you may know this multilateral treaty was in fact the culmination of the BEPS, the Base Erosion Profit Shifting discussions in the OECD context. And the PPT has now been included in most tax treaties between OECD members, and it can deny treaty benefits if one of the principal purposes of the creation of a company was to benefit from a treaty. And all that ATAD3 directive will do is make it easier for a tax authority to deny treaty benefits on payments to a shell company with insufficient substance. And this is because such local revenue no longer has to do research on whether the principal purpose test is flunked or start a GAR procedure. Typically, such procedures take a lot of time, and they only apply in the individual case that it's aimed at. So the local revenue has to make a cost-benefit analysis to see whether it makes sense to proceed and to challenge it. And again, under ATAD3, shell companies with insufficient substance will be highlighted as such, and information will be exchanged so that all the local authorities have to do is deny treaty benefits. Now, at the time this draft directive was released by the European Commission, the opportunity was given to interested parties to provide comments, and many parties have done so, including KPMG and the European Parliament, and we'll get to that later. And the general gist of these comments was, listen, do we really need this additional compliance burden for taxpayers? And should we not first take a breather and see whether all the anti-abuse rules that have been introduced recently, such as GAR and principal purpose test, may already be sufficient? And this is then just a lot of extra red tape. Given all these comments, the European Commission may have to go back to the drawing board. It's therefore uncertain whether this proposed date of January 1st, 2024 will be made. So after that introduction, let's take a look at the step process in the draft directive in order to determine whether a company as such qualifies as a shell company and the substance questions that have to be answered if that's the case. The next slide will show us the gateway test that you have to go through in order to determine whether as such you qualify as a shell company. Relevant income test, we already talked about it, interest, royalties, dividends. For now, we focus on dividends. So cross-border activity test, most income, 60% should be from cross-border activities. And that makes sense because if you don't have cross-border activities, you don't need to apply treaties. And the last one, and that's important, if you have outsourced management and administration. And the thing is, that also applies if you outsource your management internal. And we've seen situations where groups had in, say, the Netherlands or Luxembourg, one company that employed all the staff and employees in the jurisdiction, and those would provide all the services to the shell company, the holding company, like administration, board of directors, and what have you. Those would typically, under the current proposal, be included in the outsourced management. And that would mean, if that's the case, you would as such be a shell company and you would have to report on your substance. The European Parliament has said that they feel that in case the activities, the management administration, is done by an affiliate within the same jurisdiction as the jurisdiction of the company in question, and then you should be deemed to meet this test, and therefore you would not have to report on substance. So, the next step is we've determined that as such we are a shell company, and the next step is then we have to report on the economic substance, and that consists, as you can see on the slide, of three items: local directors and employees. The director should be resident in the state of the undertaking, and they should be authorized, and they should be independently qualified to do the activities. And very important there is they should not be employed by an unassociated enterprise. And that is typically aimed at the situation of trust companies. You may know trust companies that provide an office address and a director for your local holding companies. And this provision is aimed at the trust company. So if you have a trust company, you sort of flunk one of the three economic substance tests, and if you don't meet all three of them, you will be deemed not compliant, and then Michael will later explain on what the consequences are. The second requirement is that you have physical premises. So also aimed at the trust companies, because trust companies provide an office address, and this test says no, you need your own office address. And finally, you need an active bank account in the EU. So, and if you don't meet all these three requirements, then you have to suffer the consequences. And Michael will now talk about the consequences of failing to meet the economic substance test. And I think first you're going to briefly talk about a rebuttal test, right, Michael?
Absolutely. Thank you, Kees. So, yes, as you mentioned, if you do not meet the substance test, you would be presumed to be a shell. So, does that mean it's game over? Not exactly. Fortunately, the proposed directive introduced two ways out the taxpayer can invoke. First, it is possible to rebut that presumption to be a shell if one can demonstrate that the use of the shell is justified by sound commercial reason and that is not misused for tax purposes. There could be various non-tax reasons why such entities are used, but ultimately the validation of the commercial reasons falls with the competent authority. So it's important to be able to provide a document explaining all the commercial rationale. On top of that, the taxpayer would need to provide information about the role and qualification of any employees of the shell entity, as well as demonstrating a clear nexus between the entity and the member state, demonstrating that the decision making concerning the activity generating the relevant income effectively takes place in the member state of the shell. So, assuming all evidence have been provided to the members to the competent authority of the member state, then it's up to the member states to provide that, I would say, to accept that the presumption has been rebutted, and that acceptance would be valid for 1 year, potentially extended for an additional 5 years. There could be another way out, which is the exemption of the obligation under the proposed directive for the absence of any tax benefit. So basically, if the taxpayer can demonstrate that the use of the shell entities does not result in any tax advantage, then he would be exempt from all the obligation under the directive, including a reporting obligation. But in that case, one would need to prove that the overall tax burden of the beneficial owner or the group as a whole would be at least equal to the tax burden, assuming the shell entity was not used. So that's important and not necessarily easy to demonstrate. So now, as we go to the next slide, let's talk about the consequences of being a shell. So assuming you were not able to rebut the presumption, you were not able to invoke this specific exemption for absence of tax benefits. So now let's have a look to the consequence. So we wanted to outline two simple examples on this slide. So on the left-hand side, you see a EU payer making a payment to what we call a shell entity, and let's assume that that shell entity is owned by a US parent company. So the main principle of the consequence of the proposed ATAD3 would be that basically you would be looking at a look-through approach. So you would basically assess, evaluate a transaction as if the EU shell entity did not exist, right? So typically in that first example, the payment would be deemed made by the EU payer directly to the US parent company, meaning that the EU shell entity would not be able to enjoy any European directive nor double tax treaties. So now the question is, can the EU payer potentially look at the US parent company and apply a treaty with the US? ATAD3 give that as a possibility. So up to the EU payer to accept and recognize a treaty with ultimately the shareholder, but I mean up to also the countries to have stricter rules and basically deny also an application of a treaty. So that is open basically. So now on the right-hand side, we have outlined another example where in that case, the payer is not based in an EU member state. So we have a third country payer to a EU shell entity, which is itself, again, held by a US parent company. So I'm often asked whether we need to care about the proposed ATAD3 if basically the EU shell entity is transacting only with non-EU entities. But unfortunately, the answer is yes, you should be really taking care of ATAD3 because what the proposed directive is saying is that there will not be, if you're a shell entity, you will not be issued any certificate of tax residency. So very likely your non-EU payer may like to see a tax residency certificate saying that the entity is indeed entitled to a treaty for that specific payer country to acknowledge a reduction of withholding tax based on that treaty. So very well, ATAD3 can also have implication whenever payments are sourced from outside the European Union. So as we go to the next slide, let's talk about a last consequence of basically ATAD3. ATAD3 also aims at really looking at exchanging a lot of information between EU member states, meaning that taxpayer would need to report, whether they are meeting the so-called gateway tests, which Kees explained earlier in terms of, am I an entity which derive passive income cross-border and where I outsource the management? So would need also to report whether they have the minimum substance. They will need to basically report all that information to the competent authority of their member states. And once those information are received by the member state, these information would be shared within 30 days automatically to all other EU member states. And it will also include information such as whether the member state has approved the rebuttable rule, when the presumption was basically rebuted, whether an exemption for absence of tax benefit was also accepted, whether an audit has been conducted, which led to basically the fact that the entity was in the end not meeting the minimum substance. So there will be a number of information being shared automatically between all the EU member states. And there will be also obviously specific identification information with regard to the taxpayers. And the directive proposed that the Commission will basically provide some sort of harmonized form between EU member states to basically streamline and facilitate the exchange of information. So that is also obviously a big element of ATAD3. So everybody will be accessing a lot of information. So that is the end of our presentations. We hope that you found it helpful. As a closing remark, I'd like to remind the audience about the 2 years look back of the proposed directive, which means that to a certain extent, the directive is already taking some effect today. So it is really recommended that existing setup are reviewed and potentially adapted as soon as possible.
Michael, to add to that, we previously talked about the comments that had come and that the Commission may have to go back to the drawing board. But whatever is going to happen in some way or fashion, this is the future. So like Michael mentioned, the 2-year period, this is the time to see and look at your holding structures, see if they have sufficient substance, and see if you can put sufficient substance in, and if not, consider moving to other jurisdiction. We see a number of clients who say, well, do we really still need a foreign holding company because all the income is picked up immediately anyway? We're just going to put it directly under the US. And again, this is the time to do this.
Absolutely.
Thank you very much.
Thank you all.